Sam Bankman-Fried, known as SBF, was the face of crypto. His exchange, FTX, and trading firm Alameda Research dominated the industry before it all fell apart in November 2022. SBF reportedly went cap in hand around Wall Street and Silicon Valley looking for financing to keep his empire afloat during this year's crypto meltdown. But nobody would bite FTX's initial public offering. When the cryptocurrency exchange FTX filed for bankruptcy last week, it was a stunning downfall that sent shockwaves through the crypto industry. The company's former CEO, Sam Bankman-Fried, stepped down in the wake of the collapse, and an outside restructuring expert was hired to shepherd what was left of FTX through bankruptcy. Bankman-Fried's rise and fall is the story of a man who built an empire from nothing, then let it all crumble in an instant. It's a tale with more twists and turns than a Netflix thriller, and one that's not over yet. It all started with Alameda Research, a crypto hedge fund where Bankman-Fried made his fortune. The fund focused on arbitrage trades involving the spread between the price of an asset and its market cap. It was an investment strategy that in theory would allow investors to make big profits while limiting their risk. In 2021, Bankman-Fried stepped down from the board of Alameda to focus on his new venture, FTX. The company raised a slew of money from high-profile investors, including Sequoia Capital and Thoma Bravo. It even ran splashy Super Bowl ads featuring Tom Brady and Larry David. But despite the billions in investor funds, FTX was struggling to make ends meet. The value of the FTX token, which was used for trading on the platform, plummeted as the broader market crashed. And that's when things really began to fall apart. Bankman-Fried publicly downplayed the company's troubles, saying in cryptic tweets that FTX is fine and customer assets are fine. But behind the scenes, he was engaging in cutthroat competition with rival exchange Binance and its founder Changpeng Zhao, who had invested in FTX in 2019 and later took over the business. Bankman-Fried was squandering FTX's financial resources on speculative investments, regulators claim. According to a lawsuit filed by the Commodity Futures Trading Commission, he commingled the company's customers' funds with his own at Alameda and used the proceeds to fund risky bets. The CFTC says those actions amounted to fraud and is seeking restitution for the victims of the scheme. The Japanese arbitrage. In the crypto world, arbitrage refers to the practice of buying and selling digital assets in different markets to make a profit. For example, if Bitcoin is trading higher in Japan than the US, an investor could buy it in Japanese yen and then sell it back to the US at a profit. This trade requires a lot of money and the ability to quickly convert currencies. But it is very profitable and allows investors to take advantage of market inefficiencies. FTX was built around this idea, and its success brought Bankman-Fried instant celebrity status. He jetted around the globe in private planes, hung out with celebrities like Tom Brady and politicians like Bill Clinton, and his face adorned magazine covers. At its peak, FTX was valued at $32 billion, but then a leaked company balance sheet exposed a shaky financial foundation, triggering the crypto equivalent of a bank run as customers hastily moved to withdraw their funds. The company was unable to cover the outflows, and it subsequently collapsed into bankruptcy. Assistant U.S. Attorney Nathan Wren painted a picture of Bankman-Fried as a villainous businessman who used FTX customer deposits as his own personal piggy bank. The 31-year-old lied to the public, and only his small inner circle knew that he was using their funds for speculative investments, Wren said. Wren accused Bankman-Fried of stealing billions of dollars in customer funds. He used them to buy luxury houses for himself and his parents, meet celebrities, and gain influence in Washington by donating to politicians. He also used the money to bribe people into revealing secret information about rival companies and to pay off debts. The evidence presented in court was compelling, but a new jury will now have to weigh in on the question of whether or not prosecutors have met their burden of proof in bringing the case against the former FTX chief executive. The verdict is expected to be handed down in about a month. If convicted of all 13 counts, Bankman-Fried faces a maximum of 235 years in prison. The FTX monopoly. When the market crash of early 2022 hit, it destroyed many crypto companies. Some were big, others tiny. But if they had one thing in common, it was that they all needed Sam Bankman-Fried to swoop in and save them. And that's exactly what he did. He was crypto's version of J. Peter Morgan, the guy who saved everybody during the Great Depression and who even got a nickname that rhymes with his own last name, JPEG Morgan. Childs, when I started editing and publishing stories about Sam, he was worth $16 billion on paper. He was crypto's biggest celebrity, a 30-year-old elder statesman who spent his vast fortune on philanthropy. He gave away boatloads of money to animal rights charities, pandemic preparedness research, artificial intelligence initiatives, and Democratic candidates. He was also an industry savior, donating to other exchanges that were struggling. Sam was a polarizing figure, but he had earned the right to be so by being very good at what he did. He was an entrepreneur. He was a master at promoting himself and attracting capital to his firms. He was a charismatic speaker, and people loved his brash style. But in a world where cryptocurrency is still unregulated, Bankman-Fried could have done more to keep investors informed about his company's financial state. For example, it would have been a good idea for him to disclose that he was using the company's valueless token to finance Alameda Research, the trading arm of FTX. That's because, as Changpeng Zhao explained, a public disclosure of an insolvent crypto firm supported by its own token can raise suspicions about insider trading. During his CNBC interview, Bankman-Fried feigned ignorance of the commingling of funds between FTX and its trading arm. He said he didn't oversee compliance and he never appointed an officer to do so either. He also denied that he used customer funds to cover trading losses at Alameda. But documents obtained by the New York Times suggest otherwise. They show that a significant portion of Alameda's assets, up to $12 billion in total, came from FTX customer accounts. The fall. At the top of his game, Sam Bankman-Fried was a billionaire of almost mythical proportions. He was the face of Silicon Valley's fad for effective altruism, the idea that you should give most of your wealth away to improve the world, rather than simply donating to charity because it makes you feel good. He testified before Congress about crypto regulation, and he was one of the top donors to Democratic politicians. He also owned the FTX exchange and its trading giant Alameda Research, which was essentially a casino for digital assets. Unlike most casinos, which are legally separate from their owners, FTX and Alameda were linked by an inseparable balance sheet full of the same assets. In other words, if you bought shares in FTX, you got a discount on your trading fees at the sister company. But despite all the cash flowing in and out of his empire, Bankman-Fried's finances were a little bit fishy. According to a sealed indictment, he ran a Ponzi scheme using new investment money to pay off old investors and skipping out on taxes as he did so. It's an extraordinary tale, and it has left many people in crypto wondering if the whole thing will collapse. As of this writing, FTX's website has paused withdrawals, and it's unclear whether the company will survive. It could spell trouble not only for Bankman-Fried, but also for the entire cryptocurrency industry. If FTX does fold, it will be the biggest cryptocurrency blow since the market's giddy 2017 high. Its fall will have reverberations across the industry, and it's likely to prompt a wave of regulatory crackdowns in both the United States and Europe. But until now, FTX was the ultimate poster child for the cryptocurrency boom. Its logo adorned everything from Formula One race cars to Miami basketball arenas, and its 30-year-old founder was the golden boy of the industry. Now, as charges mount, his empire has imploded, and the saga of how it all went wrong is being played out in real time. And if the past week is any indication, it's going to be an exhilarating and terrifying ride.